Imagine a device that pressed juice out of a little pouch and into a glass for you for just $700, or a machine that heats up water and brews tea for just $1,000. No, not really your cup of tea? Okay, how about a smart cup that knows what you are drinking so it can tell you what you just poured into the cup, because obviously you don't already know that. Also no? Okay, hear me out. Final pitch. How about a device that checks your body for conditions like diabetes or cancer by analyzing a few drops of your blood acquired through a finger prick? You just have to ignore the fact that this is scientifically impossible. Now, you might be thinking, who is stupid enough to invest in those ideas? And if you think like that, you are probably not a Silicon Valley investor, because all those ideas raised millions and billions of dollars in funding. The big question now is, of course, why? Are Silicon investors just stupid? Do they simply have too much money to care? Or is there something else that drives this almost cult-like blind belief in technology, weird tech, and charming founders? Welcome to the Corvus Chronicles. Before we dive deeper into the nitty-gritty of Silicon Valley startups and investment culture, we first need to understand how venture capital actually works and how they make money. And don't worry, it's pretty simple. VC companies pool money from their partners and invest them into a variety of high-risk startups, which have the potential of producing 10 or even 100x the return on investment. As soon as the startup reaches a certain valuation, the VC sells their shares and repeats this blueprint. Most VC companies are fine with a high failure rate, since one company making it can make up for dozens of failures. Now, all of this might sound great at first. Startups receive funding and investors get a good return. But there are some minor problems with this. Most VCs do not actually care about innovation, startups, or sustainable growth. They care about a high return on their investment and a quick exit. This leads to companies burning through cash simply to increase certain metrics, or VCs investing money into companies simply because they have a charismatic founder. And it also opens the door for ideas that nobody needs, scams or frauds. Throwing cash at a problem until it sticks does work sometimes. Airbnb needed over 8 years to finally make a profit, Uber over 15 years, and Spotify just had its first full profitable year in 2024 since its founding in 2006. But you could also end up like the co-working company WeWork. They raised billions from their investors, and at its peak, they were valued at $47 billion. However, just 4 years after its IPO in 2019, they filed for bankruptcy. The investors focused on Adam Neumann, the founder of WeWork, and the dream he sold them, instead of looking at the actual company and the data behind it. Ever since Steve Jobs made Apple into one of the biggest companies in the world, investors in Silicon Valley have been looking for the next Jobs. They believe that true geniuses have to be crazy, so Neumann played the part perfectly. He walked around barefoot, was vegan, smoked weed, talked about becoming president of the world, and pitched an office subletting company as elevating the world's consciousness. And because he sounded like a madman, investors assumed he must be a visionary. The reason why VCs love founders like Neumann is because, again, they do not actually care about the company or the product or even the profits. VCs usually make money when a company gets a higher evaluation in a founding round or is sold to a bigger company. Therefore, what VCs actually need is a founder who can convince other investors to fuel more money into the startup, either through unimportant metrics or by being very charismatic, or you could simply lie. Let me introduce you to Elizabeth Holmes, founder and CEO of Theranos Incorporated. The idea behind the medical startup was quite simple. Elizabeth was scared of needles and blood and wanted to create a device that could conduct various blood tests with a tiny amount of blood, acquired through a finger prick. Through her charisma and her vision, she was able to convince people like the media mogul Rupert Murdoch or the Oracle founder Larry Ellison to invest into her company. And her board of directors consisted of Henry Kissinger and George Shultz, 2 ex-US Secretaries of State, as well as a retired Marine Corps general, a former US Secretary of Defense, a former director of the CDC, and a former CEO of Wells Fargo. Why were ancient politicians and war generals on the board of a healthcare startup? Because in Silicon Valley, social proof replaces due diligence. Nobody wants to do the boring math if Henry Kissinger is already in the room. Holmes didn't build a medical board. She built a shield of untouchable, powerful old men who were too arrogant to admit that they did not understand the science behind it. At its peak in 2013, Theranos was valued at $10 billion. All of this came crashing down when eventually people learned that A, their device actually does nothing at all, and B, blood tests do not even medically work with such a tiny amount of blood. By the way, Elizabeth was sentenced to 11 years in prison for that, and the whole story behind the scandal is insane. So if you want a deep dive, just looking at Theranos specifically, tell me about it in the comments down below. Okay, but those are outliers, right? Well, actually, only about 20 VC firms are responsible for 95% of the industry's profit. The irony, however, is that those other 98% of VC firms are responsible for making those profits possible, since startups usually only get evaluated by how much funding they receive in the investment rounds. In finance, this is literally called the greater fool theory. The VC doesn't care if WeWork actually makes a profit. They just need to inflate the evaluation enough to sell their shares to a greater fool down the line, usually another VC or eventually the public stock market. So why do they keep doing this? Why do people invest into Silicon Valley startups like there is no tomorrow? Well, the problem is nobody wants to miss out on the next Google, Facebook or Apple, but nobody actually knows which company is going to be the next big thing. So they invest into everything that sounds good, no matter how bizarre or stupid it sounds. And to make it even more insane, a lot of startups work with the fake it till you make it attitude, which means, especially in the beginning, most of them kind of feel like a scam. But the system does seem to be working. For every failure or scam story I told you today, I could tell you a story about a social media startup, a robotic startup, or a rocket ship startup. The problem seems to be not the investing itself, but rather how we do it. Many VCs seem to be blindly following a charismatic founder or a trend. We have seen the same story over and over again, whether it was blockchain, the metaverse, or artificial intelligence now. It seems like most investors simply throw money at startups as long as they say they follow a trend. Now, you might be thinking, who cares? Let the billionaires investors lose their money. But the problem is VC fund startups usually use cash raised through their partners. And those are pension funds, sovereign wealth funds, corporate investors, and yes, also high net worth individuals. When Theranos collapsed, real patients received false cancer and HIV diagnoses. When WeWork crashed, thousands of regular employees lost their jobs, while Adam Neumann walked away with $1 billion golden parachute. The investors play with other people's money, the founders negotiate their exit, and the public, the employees, and the consumers, those are the ones that actually lose out. Thank you all for watching. If you enjoyed this video, please leave a like, comment, or subscribe, and I'll see you in the next video. Bye!